I think it's important to distinguish between strategies in the fixed income space that are reliant on interest rates staying low or going lower, and strategies within the fixed income space that can protect you from rising interest rates, like the strategy we employ in the Lawrence Park Credit Strategies Fund.
The credit markets in March were coming out of two very strong months. We'd seen a big rally, obviously, in the equity markets, and that had flowed through to the credit markets. We knew in March that there was going to be a lot more issuance, especially in the US corporate market, so we were a bit more cautious. We decided not to reach for credit, but rather let credit come to us. That certainly played out with a lot of the new issue supply. Dealer inventories in the US grew, and spreads were fairly stable and perhaps even a touch softer in places. In contrast, the Canadian market, the technicals were very different. There was very little issuance. We were actually surprised how little issuance there was. The technicals were very strong, dealer inventories were light, and we actually saw some good performance out of Canadian credit during the month.
I think we're already seeing it impacting the fixed income market, and rates are starting to rise. People's expectations of when rates will go higher are changing, and that's going to manifest itself in bond prices going lower. And we think that investors need to give serious consideration to their fixed income weighting and think about how they can protect themselves from interest rates going higher.
Credit spreads are much like equities. They are sensitive to economic data, and if there's a sense that the economy is slowing down, then that will be felt in credit spreads generally. So you have to take a macro view of how the economy is faring. We have to look at some global issues such as the situation in Europe right now, the economic picture in China. We're watching all of these things, and I think what's particular about our strategy is the ability to go short credit as well as long means that we can trade from both sides of the market and deliver much more consistent returns regardless of the direction of credit spreads and bond prices.
We've had a 30-year bull market in bonds, and interest rates are at historic lows. The reality is that the ability of the market, the fixed income market, to continue to generate the returns that we've seen over this past 30 years, and I guess more recently in the last 3 or 4 years, is going to be very, very difficult. And people need to think about diversifying their fixed income holdings into strategies that aren't reliant on interest rates continuing to drop, will still generate income and deliver them capital preservation and low volatility.
We were pleased with the Lawrence Park Credit Strategies Fund in March. We were able to participate in some high-quality new issues coming in the US. We were also able to take advantage of the strong technicals in the Canadian market. The next few months are going to be less about trending markets. We think it could be a stable period with headline risk leading to short-term shocks. As such, we are much more focused on particular situations, on trading the book from the long side and the short side, really looking at relative value and actively managing the portfolio to try and generate returns.